Moving on, I'd like to talk to you a little bit about what I believe is really the most important aspect of your investment portfolio, and that's risk versus return. And that is really how much risk are you prepared to take in order to achieve the kind of return that you want to get. Well, the first thing your advisor should be doing is to get an idea of what type of an investor you are. And at Langlois Financial, we have our clients complete risk analysis profiles, and we use cutting-edge tools to help you determine your risk tolerance. But it's really only part of the story, because that, along with getting to know you personally, is the only way for us to truly know how you feel about investing. And the better we know you, the better we understand your investment philosophies and what you need. Next, we look for funds that have good managers and great track records. And we also look for what type of return these funds are going to provide and how much risk we have to take to get that return. Many advisors sell funds solely based on return, and unfortunately many investors purchase funds solely based on returns. And it's a huge mistake, because history has shown us that risk is actually more important than return. And I want to give you some examples to back that up. Now, when you're looking at these examples, I want you to keep something in mind. When we talk about volatility, what that is, volatility is basically used as a measurement of risk. The lower the volatility percentage rating, the lower the risk that you're taking. Excuse me. So Tim Hortons returned an average of 0.7% per month from December 2007 to December 2012. And their volatility rating was 20%. And their cumulative return over that period was 40%. Now, over the same time frame, Precision Drilling had exactly the same monthly return, but their volatility rating was 60%. And that resulted in a cumulative return of approximately minus 38%. If you look at CN Rail from December 2001 to December 2012, and Suncor, they both had average monthly returns of 1.3%. However, CN Rail had a 20% volatility rating, and their cumulative return was 350% during that period, versus Suncor, which had a 32% volatility rating and a cumulative return of 200%. Take a look at Kellogg's and Renault. They share a 0.4% rate of return from October 2004 to October 2012, and the volatility if you owned Kellogg's was only 15%, versus the volatility if you owned Renault was 45%. And that translated into a 37% cumulative return for Kellogg's and minus 39% for Renault. So I think you can see from these examples that managing risk can make a huge difference to your portfolio. And what you make isn't as important as much as what you get to keep. And we believe in a strategy that looks for funds which provide good return for the least amount of risk possible. And remember, it doesn't matter how much funds return, but rather in a down market, how much loss you could be exposed to. Now, from gauging fees against fund performance and developing relationships with our clients, weighing risk versus returns, and so much more, my hope is that you now have a little better understanding of what goes into creating a properly constructed portfolio.